Welcome back. Believe it or not, there is nowadays a crowdfunding institute of Australia. So let's find out about it and ask the question, why are a bunch of total strangers happy to give money to people whose prime goal is to make money for themselves? Or is there more to it than that? Joining me in the studio is the Institute's chairman, Matthew Pinter. Matthew, welcome. And its director, Chris Gilbert. And Chris, welcome.
Thank you,
and up in Brisbane, we have Paul Niederer, who's the CEO of the Australian Small Scale Offerings Board. Paul, thanks for joining us.
Yeah, thanks very much.
Okay. So, Matt, let's start with you because you're the chairman of the Institute. What is this institute, the Crowdfunding Institute?
Okay, so it's a national body for crowdfunding. So I'll correct you just slightly there.
You always do, Matt. You're a chartered accountant. I'm an economist. You always correct me. Go on.
Thanks, mate. So it supports all types of crowdfunding. So that's pledge and reward and equity and property.
What's the difference?
Oh, there's a big difference.
Well, tell us.
So we were talking about pledge. It's about people giving for a particular project. Yeah. They're contributing for an outcome. Yeah. And there's some great examples of that.
Well, I think Brutopia started that way. He basically put some sort of silly email and said, why don't you support me create a brewery? And people started giving him money, and all of a sudden he kicked off. Was it big pledge, I guess, was it?
Yeah, exactly. Yeah. So if we go into equity, which is where I sit, and also the rest of the panel, you are right. We're actually in a space where people are trusting others with their money. Yeah. If we look at property, we're in a similar space. Rewards is kind of not there. It's where somebody's promising to deliver a future product, something that's exciting, a bit innovative. Yeah. And
including be good socially or something like that.
Yeah. So there's various combinations of how somebody can crowdfund. Really, where the hot topic for the Institute is at the moment, because of rounds of Treasury reform, is in the equity space. So we're looking at innovative startups and how to foster that innovation. Okay.
Now, Chris, you've started an actual platform for this. So tell us about the platform and tell us why you're doing it in New Zealand.
Yeah, so for the last 8 months, we've been building an equity crowdfunding platform. Yeah. We've attempted to launch this platform in Australia. It's that the current legislation and environment here doesn't allow us to operate properly.
Why?
Well, the ASIC guidelines on advertising restrictions, the 2012 retail cap, there's a 59 employer shareholder cap as well. Yeah. So what myself and my co-founder and managing director, Johnny Wilkinson, have done is moved to New Zealand. Yeah. We've got a licence for equity crowdfunding in New Zealand, and we've launched our first offering over there. So we're now raising money for Kiwis, being an Australian company in New Zealand.
Okay, right, yeah. But why do you think ASIC is worried? Now, just be objective. Obviously, you don't think there are the dangers outweigh the positives, but there must be some dangers if ASIC's not saying, "Oh, way you go, guys, go for it."
Yeah, so there are dangers, and the dangers are there are private companies with reporting and transparency of information. Yeah, mum and dad investors not understanding investment. Yeah. But I guess what we're trying to work with Bruce Bilson and ASIC and Treasury with at the moment is to mitigate those risks. Yeah. So to change the Corporations Act in a way which enables us to have a strong regulatory environment to enable startups and private companies to still raise capital from the crowd, but have, I guess, processes in place to enable proper reporting and transparency information. Okay,
well, Paul, I believe you have an example of a company that's gone through the crowdfunding stages and has ended up listing. Can you talk to that particular example? Because it's obviously a good example of what can happen.
Yeah, well, every company that starts off, often in the beginning, the investors or the VCs, angels and people like that, they're not quite at that ready at that level to do that. So what they need to have often mates and mates of mates and people like that to invest to get the thing going. And as it progresses through and grows and develops, then a different category of investor is involved. And that's where the regulations and things are heading now, whereby you can allow that spread of people to become involved and invest. And yes, I think, I don't know, 4 or 5 of them have ended up on different exchanges around the world that have come through the ASOB process, but it can take like 5 years or so to take that journey. Some are sometimes quicker, but it can take a while.
But Paul, have you come across examples of where, you know, the smart Alex get involved and they, in a sense, ruin what is a good concept?
No, not in our case. We've had around 320 raises, and I think if you look around the world, see, it's a different world now. When you go back to the 30s when securities regulations were written, there was no internet, there was no transparency to look at. If people now dirty their nest when they're building a company, it's out in the internet forever. So I think that when you asked your initial question about ASIC, it's a completely different operating environment now for this early stage investing, because it's people telling people about an opportunity, which means that they share not only the good and the bad. And so if they invest, they share information that, you know, will either get people to invest or not. And so that's why when you go back to what Matt and Chris were saying, it's really important that the regulators and that look at it in that vein.
Now, Matt, you know, being a chartered accountant, chairman of the institute, you know, I worry that there's a certain country in Africa that has used the internet to fool a lot of people. Mm-hmm. Now, obviously, your role will be to try and give certain crowdsourcing initiatives the tick of approval. Is that the goal of the Institute? If not, why not?
Yeah, it is part of the responsibility to have an educational curation of the industry, and then also, particularly at a platform level, to curate how an issuer goes to market. But I think this is a bit of a disconnect in terms of how equity is being looked at by regulators around the world. That regulators are taking the view that equity crowdfunding will be very similar to rewards-based crowdfunding, which has got some colourful examples, shall we say. Potato salad was one that was crowdfunded. So when you look at that, it's easy.
Did the potato salad work or fail?
It didn't fail. It came up Trump. So
yeah, really. It looked like a fail waiting to happen, but it succeeded.
Absolutely. Yeah. So we're not talking about potato salad, though. When people, as Paul mentioned, we've got companies that are issuing shares, so that their rights involved. It's a very different decision that's being made from somebody saying, yeah, I like the idea of that, move on, versus going forward into a transaction where there is no return, not likely to be dividends in the short term, but a capital gain down the track. So I could ask you the question of, do you remember the person who sold you your last couch or TV? You'd probably say no, but if you probably remember the first stock you bought and how much money you made. So these are different types of decisions, and they're processed in different ways. Consequently, the numbers of investors are quite often smaller. And the work that goes in behind the scenes is much larger.
Okay. Well, Chris, if someone was thinking about being a funder, where do they go to make sure that they're across the information so they're not going to be complete dopes and get taken for a ride?
That's a good question. So what the intermediaries being Equitise does is we do...
That's your platform, Equitise.
That's my platform.
Okay.
We do background checks on the directors of the business, bankruptcy checks, we do insolvency checks to the businesses. So we do basic checkbox tests of all the people involved in the business. We require an information memorandum, audited financial financial records on the platform. So we provide all the detail for investors to make their own analysis of the actual business raising capital. It's in the intermediary's best. It's in their best interest to put companies up which are probably going to be successful in the future. We don't want to put businesses up which are going to run away with people's money. So we're doing our best to pick the best companies to put forward to the mum and dad investors.
Okay. So I don't know what the Latin is, but it's investor beware.
Exactly.
Okay, guys. Thanks for joining us. Good luck. And it's the Institute, Crowdsourcing Institute. Give me the correct name, Matt.
CFIA, Crowdfunding Institute of Australia.
Oh, great. Thanks, mate. Thanks for joining us. Coming up, we'll look at a company that changed the workplace to suit their workers.